And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman, where he speaks about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. Like the podcast as well. And if you have not yet done so, please subscribe to our YouTube channel and to the podcast. So there was a really interesting article in the New York Times. Go figure, a couple of weeks ago, about why you lost money in the market last year and you ended up with a big tax bill. And two-word answer to that is mutual funds distribution. 3 words: mutual fund distributions. I'm going to read a little bit from the article, and then we'll get into it a little bit more in more depth. It's written by Jeff Sommer. He says, tax planning is usually the least of my financial concerns. Most of the time, just making a living, paying the bills, and salting away money in suitable investments are much bigger deals. But this is a special time of the year. Tax season has begun, and brokerages and fund companies are sending out tax forms that the IRS requires for this year's returns. A lot of them, he writes, contain bad news. Nearly everyone lost money in the markets last year. Yet many people with investments in taxable accounts are just learning that their money-losing holdings are also generating tax bills. It may seem unjust, but under current rules, when a fund manager sells stocks and bonds that have appreciated in value, or when the fund pays out dividends and interest, these tax liabilities are passed along, even if your investment in the fund lost money. Okay, we'll pause for a second. These are called capital gains distributions, right? When the fund company, you own a mutual fund, okay, and in that fund there was a profit of some stock, let's say, or a bond, and the fund manager, for whatever reason, decides to sell it, that gain is passed on to you. Okay, just keep that in mind. That's called a capital gains distribution. Going back to the article, what's more, if you bought a fund shortly before it passed along a taxable distributions in late December, you will have a tax liability for the fund's activity over the entire year, even for the months when you did not own the fund. Okay, now the Jeff Sommer only speaks when you bought it a few months previous to the distribution. But there's another aspect. Let's say the fund manager bought shares of Apple stock 10 years ago. And then because the market was dropping and people wanted to sell, he needed to raise money to pay out those who were liquidating their holdings. And because of that, the fund manager needed to sell shares in Apple. Well, you're going to get stuck with that tax bill, okay? You didn't even participate in any of the upside of Apple because you bought the fund, too late, or even after you already sold it. But nonetheless, you're paying taxes on something you never even owned. Why is this important? Okay, it's important because there's been a big move over the last few years away from managed mutual funds, actively managed mutual funds. Now, I'm not going to get into the whole issue, whether active investing is better or passive investing is better. And again, I don't like to speak necessarily about tax issues. That's something you really need to speak with your accountant to get sound accounting advice. But one of the big issues with mutual funds is they're not tax efficient. Why? Because what we said, right? You end up paying taxes on something you never hold, you never owned even, or you could have lost tremendous amounts of money in the fund and still have to pay taxes on it, right? There's something unjust about that. Now, there are ways that you can create a portfolio where, it's a much truer, let's say, tax or capital gains tax situation. We're only talking about, obviously, taxable accounts. If you've got an IRA or other kind of retirement account, then this is a lot less important. But, if you buy an individual stock, right? So that's a true capital gain, let's say, if you ever sell the stock and you realize the gain. So from the point to point, right? The point you bought it, the point you sell it, if there's a gain, you pay tax. Okay, that's fair. That's just. What are called exchange traded funds, where a lot of the monies that have left the mutual fund world have gone and parked themselves into what are called ETFs, exchange traded funds, are also point to point for the most part. There are some which are not, but for the most part, you buy the ETF, you sell it 10 years later, 3 weeks later, whenever, point to point, from the time you bought it to the time you sell it, that's the capital gain. And you've got other things in your portfolio which you can use if you have losses to offset those as well. That's called tax loss harvesting. We've spoken about that in the past. You can look obviously at some of the previous shows and find that as well. But again, I don't want to get into too much about the tax connotations of everything, because you really need to speak to your accountant about that. I'm not a CPA, I'm not a licensed, I don't even play one on TV. But it's important to know why mutual funds are not efficient. I'm not even going to get into the point that they tend to historically way underperform the benchmark that they're up against, whether it's the S&P 500 or some other stock market or bond market index. You know, there are multiple strikes against mutual funds these days. But I think the biggest strike is, you know, there's also strike three is their higher fees than you pay with ETFs, or obviously with individual stocks where you don't really pay internal fees. So they got three strikes against them, right? Fees are high. Number two, performance tends to be statistically lower at least. And the big one, which is over time, is they're so not tax efficient. Okay, so we've struck out on mutual funds. Okay, three strikes, baby. You're gone. You're out of here. Ring them up. But like I said, where do you put the money? Well, there are those who will, you know, always be fans of individual stocks, or perhaps for many of you, ETFs, exchange traded funds, are much more practical, much more diversified, less hands-on, and low cost, I should say. And they track the benchmark, right? So you can't, you're not gonna do better or worse, but they track the benchmark, which is something that's very, very difficult for most fund managers, even who are professionals, to do. So we have rung up, right? It's almost pitchers and catchers, right? It's almost spring training. We've rung up the mutual funds, three strikes. Why they are not great. Now, if you've got them, you've got to think twice, right? Should I sell them if you've got other capital gains involved? Again, these are questions for your financial advisor, questions for your accountant, but just, you know, it was an interesting article, and it was from the New York Times, right? So I had to point it out, because that doesn't happen very often. And it pointed out not why inherently mutual funds are bad, but the surprise people get. But I'm telling you from my professional background that there are issues with mutual funds. There are issues with everything, and you have to weigh what works in your portfolio based on your own asset allocation. You know, do mutual funds actually have a place in the portfolio? But even if they do, you have to go in with your eyes open, right? Understand that they can be tax ramifications. They're not efficient, particularly when it comes to tax. Again, they cost more because of the management fees internally, and they tend to, statistically at least over time, underperform. Again, this is only talking about taxable accounts. If you've got IRAs, retirement accounts, 401ks, whatever, that's a different story. But I thought I would share this little nugget with you because it is important, and overall, over time, there's a lot of money involved. You know, there are funds which pay out 5, 10%. I think the article, he even brought a fund from the Delaware Fund Group, and they changed their entire strategy of the fund. They ended up realizing they distributed like 61% or something, like, if I'm not mistaken, of the fund's worth was in capital gains. So people just got clobbered and they lost money. Okay, so be smart about your investments. It's just another thing that you should look out for to make sure that you're investing, you know, correctly, efficiently, cost efficient, and tax efficient as well. Thanks so much for tuning in. You have been listening to the Aaron Katzman Show, where we speak to you about your life, your money, and your investments. If you like this, please hit the like button below. Like the podcast. If you've not yet subscribed, please subscribe to both the podcast and to the YouTube channel. Thanks so much for tuning in, and we'll speak to you soon.